Welcome, ladies and gentlemen. This is Andrew here with Spark Finance. And today I wanted to go over, when you're looking at an asset, is it a speculative asset or is it a golden investment grade quality purchase? That's the question, right? How do you differentiate between these two different options of investments? Now, normally when you're buying an asset, you're making a purchase, the goal is to either have income from that purchase or to have an appreciation in the value of that asset over time. So in the future, if you have a house, you buy it for $300,000, you sell it for $400,000, that's a $100,000 gain right there. So those are the normal ways, right? And let's say for income, you buy a stock that pays you a dividend and you make $100 a month based on the shares that you own of the stock. Speculation, on the other hand, it doesn't really care so much about what the asset is or the risk of potentially losing your initial investment. It's about the outsized return that you can get if you put money into this. And that seems to be the major difference here. When you're looking at speculator versus investor, one of the earliest terms of this came up with reminiscence of a stock operator. So this book right here was one of the most recommended books for people in the finance industry. And it's based on the real life story of Jesse Livermore from the early 1900s to 1940. And what he was doing was basically speculation. And a lot of what he said in that book still holds true today. It's very interesting. And when you're looking at a speculator, and we'll do this one first because this is the interesting and exciting one, right? So a speculator, they really care about momentum. As long as the momentum is going in the same direction that they want for their purchase, they're going to purchase it. Like, let's say you know somebody that invested in Bitcoin or cryptocurrency and they were making all this money on it. They purchased it way back when it was $100 a coin. Now it's, thousands a coin and they're making all this money. I want to get in on that. I have a fear of missing out, and people pile into a speculative investment for fear of missing out. They don't really care about what the actual asset is. They don't care if they're investing in Bitcoin or Beanie Babies or stocks and bonds, as long as they have the potential for that outsized huge return. And that's why speculating is a lot more like gambling, right? So if you're gambling and you go to the store and you purchase a lottery ticket, you might make millions of dollars if you have that one winning ticket. But think of how many people also purchased a ticket that is now worth nothing. There is a lot higher chance that you're going to be on the group, that huge group of people that purchased a ticket and didn't win anything, versus the small group that actually won with the winning lottery ticket. And when you're investing in speculation, a lot of times people don't care about the loss of the initial investment, and that's almost sacrilege in the normal investment world. When you're going to kind of bet the farm, and that's what Jesse Livermore did, and I'll go back into his story a little bit later as well, but he bet the farm several times to be able to do speculative investments and make a huge outsized return. Now, an investor on the other side, they're very concerned with what's my downside risk. What's the chance that I'm going to lose that $1,000 I put into, art or sports collectibles? If I bought a basketball card that was very rare, right? What's my chance that that's going to go to zero? What's my chance it's going to lose half of the value? And it gets really crazy with the details on this because financial analysts do a Monte Carlo analysis on the asset to say the probabilities that they're going to lose their entire investment, the probability it's going to double, the probability they're going to lose half of their investment. And so what happens is, let's say there's a 5% chance you lose your entire investment. Let's say there's a 20% chance you lose 70% of your investment. And let's say there's a 60% chance that the investment doubles. Since the probability is higher that there's going to be a profit on the asset than taking a loss, that's actually an investment grade purchase right there. Speculation, on the other side, maybe you only have a 10% chance to actually make a profit on it. That's a speculative asset, because even though you can make a lot of money, there's only a 10% chance. So a lot of this has to do with probabilities. Now, Warren Buffett said, and Warren Buffett's one of the greatest investors of our era, if not of all time. He said the number one rule of investing is never lose money. And the number two rule of investing is to remember rule number one. So the important thing here is that you worked so hard to earn money and to be able to save money so that you can make a purchase of an asset, you don't want to lose that initial capital that you built. And that's why investing looks at, how can I preserve this capital, make sure that I do not lose it? Where speculation says, we don't care about your capital, we just want to see how much we can potentially get. We can 100x this, but we might lose everything. And I think it's important to look at both sides of the argument there. And you look at what assets are considered speculative, and you have trading options and futures and Forex and currency trading and stuff like investing in startup companies and also short selling. So like in short selling, for example, with stocks, your potential downside is infinite because the stock price can go up and up. It could be $100 share, and then it could go up to something like $3,000 a share like Amazon. And if you're betting that the company's going to go to zero when you're short selling, you're limited from $100 to zero is your profit area. And then $100 and up to infinity is your potential downside risk. So that's why those are considered speculative. Same thing with options. On options, if you do not make your action, if you don't exercise the option by the date of the contract, it's worth zero. It's not worth anything anymore. So you either make a profit on it or it's worth nothing. That's a speculative investment. On the other side of this, when you're looking at a normal stock, you're looking at the company itself. You're looking at 10K reports, quarterly reports. You're looking at the history of the stock price performance, how the market has been reacting to it. You're looking at the management team, what the changes are there. You're looking at insider buying and selling. There's a lot of different aspects around the company that you can do to kind of get rid of the clouds in the future. I mean, you're trying to predict the future here, which is inherently difficult. So if you're an investment, if you're trying to make an investment, you're looking at all of those things and you're getting rid of some of those clouds. And the important thing here is that you have a lot of historical data to go on. And that's something where everybody went into the cryptocurrency market in the beginning and they were confused by it and they were thinking, man, this is rough because it's only been around for a few years. This is really speculative. This is probably going to go to zero. Then that came out in 2009 with Bitcoin and blockchain. Now we have over 10 years of data and you're starting to see people that are major financial leaders around the world going into cryptocurrencies now, in particular the big ones, not so much the ICOs, which are very speculative and sometimes scams. But yeah, so you see this change when you have historical data. You can even see it in stocks, which is, again, an easier example where when an IPO comes out, that's pretty speculative to try and get into the IPO. You have no idea how it's going to perform on the market. But if you wait 3 to 6 months, then you can see how they do for their quarter, how the stock price, the share price has been performing over time. Most financial books say you should wait at least 3 months before you go into those, just so you can see how it trades and how it goes moving forward. So there's a lot of different parts of this that you have to look at. If you're a day trader and you're just trying to predict stuff on a hour-to-hour basis and buy and sell a stock on an hour-to-hour basis during a day, do you really think you can do that for a prolonged period of time accurately? I mean, we can't even tell if it's going to rain tomorrow at a certain hour. And yet you're telling me that you're going to be able to make those predictions. That's very speculative that you believe you could tell the future that clearly. On the other side of this, if you're looking at an investment and you're doing financial analysis on the asset, then you have a better idea of the picture of the future of the company and what it's going to look like. And that helps you make a decision on, is this investment great or am I going to potentially lose my investment? Now, of course, a portfolio can have speculative investments. You can be a speculator and an investor. The point is, you have to be able to look at an asset and say, is this speculative or is this investment grade? Because it's important to know how much money you can lose. Most financial experts say that you should have about 20% of your portfolio in a risky or speculative asset class. So 20% is not a lot, but it's not a very small amount either. If that 20% has an outsized return that a speculative investment can do, well, then you're really well off. But on the other hand, if it goes to zero and you lose everything, which happens a lot with speculative investments, you still have the other 80% of your portfolio that is doing fine and can make up the difference. So that's why it's important to figure out what's speculative, what's investment, by looking at the overall picture of it, the historical data, the people's belief in the asset here. And this is why, you look at Jesse Livermore, who, yes, he was able to be very successful speculating in different fields. He made millions of dollars and then went broke 3 times over. And then unfortunately, he ended up killing himself in 1940. So it wasn't a happy end for that kind of method of investing. Whereas, you see happy-go-lucky Warren Buffett here still kicking at an age when most people can't even have brain function. And it's pretty crazy that, what it can do if you have the financial security of doing good investment decisions over a long period of time. And that's what this is about, is really seeing, okay, speculation is not inherently bad, but it is riskier and it is a smaller part of your portfolio. Thank you everyone for watching. This is Spark Finance. I'm Andrew, and I hope you have a great day. If you want to check out some other videos of mine on economics, investing, or business, check out the other videos on the channel.